Good morning and welcome to this What's Up with the Market webinar. This is a supplementary market status update I'm going to do today. We did do one of these last week, but given what's happened over the last few trading sessions, I think it's only apt that I do another one and do an update on that because the movement's been quite large. And I've also called this Trump's tariff turmoil. So we'll have a look at the markets. I'll try and stay away from subjective innuendo. There is obviously a ton of material being written in the mainstream media and elsewhere, and I'll try and stick to the data and what we're seeing on the charts. I'm also going to do something today because it's highly relevant, and to bring it into this discussion, and that is talk about the market risk research that we've been doing, and I'll give you the background to it in a moment. So that's item number 2 on the agenda. And I'm also going to just step back and just look at some other more high turmoil type periods in the market, just to give a bit of bigger picture perspective on what's going on here, and from a market perspective, from a data evidence-based perspective, and just try and put that into perspective and step out of the short-term, highly emotional, high hype, highly volatile environment, and just see things from a 10,000-foot bird's eye view a little bit more, because you're not seeing much of that in the mainstream agenda at the moment, in the noise that's going on. So let's just get into this presentation. Firstly, I must remind you that so what I'm going to do is I'm going to go through a presentation first, and just some snapshots of charts, and then I'll get into beyond charts, and we'll just have a look at the main indices at the moment. Right, none of this generic technical analysis that I cover in this webinar is used in SPA3 Investor or SPA3 Trader. I don't use it in the ASX public portfolios to trade those 100% mechanically, as I do for my own personal buy-sell decisions in my own portfolios outside of the public portfolios that you see. And I am a declared mechanical trader and precisely follow the rules of our systems. Okay, let's get into the big picture perspective. So I'm going to go back and look at World War II and just give an idea of what happened here. So the story behind this picture is on the left-hand side of the chart over here. This is 1935, 36 into 37, so 35, 36. There was 131% rise in the S&P 500. Now, this was during the Great Depression, right? And obviously, the economy was, I won't go into the story. You all know, those of you that have read up on history. And then that was obviously, so that was in dire economic circumstances. Market found a way to rise, and in fact, Roosevelt used tariffs back then as well. Both Roosevelts did. Teddy back in the turn of the century, and Eleanor as well, right? And Franklin D as well. Then there was this huge fall. What is that? About a 59% fall over a period of time. And then the war started during this period of time. So a world war broke out. And in 1942, here you can see the base, the trough was in 42. And through to the end of the war, the market rose 158%. And I think you would say, we're talking about tariff wars and there's military wars and all sorts of things. But the reason I bring this to point is that even situations, worldwide situations that have massively negative connotations, markets and industry and whatever work things out. They see an angle. That's what capitalism does. And and what happened in the Second World War was there was obviously a massive industrial push to develop weapons and created jobs, and and all sorts of things was happening. But there was massive borrowing going on, and that was going into industry. Now, I'm not saying that's what's going to happen here, but what I'm saying is that there are variables that impose themselves, if you like, on the world. and a lot of the variables sometimes only have an effect on a particular part of the world, and we don't even hear about it. And their financial markets react in a certain way, and then ours the same thing. So, but here every now and then we have variables that impact the whole world, and that's what's happening right now. Now, it's not a world war that's happening now; it's a tariff war, to use the word, and it's and that is a major variable, and it's disrupting, right? But this is not the first time that we've had major disruptions of by variables on the whole planet. And the point to make here is that the ingenuity, the innovation, et cetera, of humankind is that they find a way. And what we don't know is how quickly they find a way. But this is going to play out, whether it's short-term, long-term, whether there are forces brought to bear on Trump that get him to change his mind, or whatever his plan is, it plays out, or somewhere in between. There are going to be other variables that are not just going to stand still and do nothing. They are going to change as well. And those variables might not have done anything, or they might have been lying dormant, sitting in the background, not even worrying what's going on. And suddenly those variables now become relevant. They were not relevant before. And we don't know what those variables are. And that is why, fundamental truth number 2, I do not need to know what's going to happen next in order to make money, is just so true, right? And that anything can happen, also so true. But what we do is, and I'll make a point in our summary later, is that this thing called all these biases and heuristics that Kahneman and Tversky spoke about, they're all happening here in our heads. And one of them is recency bias. And human beings suffer from it, I think, and it plays a far bigger role than what people give it credit for. Is that we think that what's happening in the short term is going to persist and persist forever. So will tariffs persist forever? Well, we don't know. It's not known. We don't need to know what's going to happen next. But will tariffs as that single variable, if they do persist, are all other variables going to stay stagnant? And the answer to that, if you do want to know what's going to happen next, is they're not. They're not. But we just don't know how they're going to conspire and mix together, and how that's going to play out in price action and companies and how they organize themselves. I mean, there are a lot of things happening very quickly at the moment. I think the count now, it was 1 or 2 countries, then 30 countries, and now it's 70 countries. I've read more news and newspapers than what I have for a long time, just getting people's views. Reading left-centered newspapers, right-centered newspapers, you name it, right? And the one thing that's coming out of it is that nobody knows what's going on. And even despite the fact that nobody knows what's going on, how do I know that? Because everybody's contradicting each other. And everybody's got theories, everybody's got variables, everybody says this is going to happen. And people that have never commented on the stock market in their lives before, who are just political journalists, are now got a stock market view. And they're making predictions, believe it or not. So why am I saying this? Well, the other slides bear this out as well. Let's go to 1987, and this. Now, the first thing is that last slide I showed you was in the middle of a secular bear market, and that actually was the thing that took the price action from a secular bear into a secular bull. 1949, I think it was 1948, 49 broke out the top, and then we had this massive secular bull market that came out of that. Now, 1987 was in the middle of a secular bull market, not in the middle of a secular bear market. And here you can see this 1987 crash. People are starting to like, and I think there was a prediction the other day that there was going to be a 22% fall on the US indices, just like 1987. So that, even though I say recency bias plays a major role, people go back and they look for what? They don't go and look for the positives that happened historically. They go and look for the negatives. They go and look for the pain. They go and look for the sensationalism. But what they don't carry on the story with is what happens after the pain. What happens after the sensationalism is that markets recover. Other variables conspire to do things. Things change, right? And markets continue up. We just don't know when. 2008 is another one. I'm only going to give you 3 examples. But the point I want to make here is that in the middle of henny penny, the sky is falling on our head, is that it never seems to. And the innovation, the ingenuity, the optimism of, even though it might be in a minority at the moment, these people see a way forward, and they innovate and they change. And already despite countries coming to the negotiating table, they are now, I just read this morning at Ford and GM are changing their manufacturing plants. They now are turning on dormant plants that they had moved out, to Mexico and Canada, and now they're shutting down the Mexican and Canadian ones, and they're bringing them back into the United States, which is partly what Trump wanted. Now, we don't know where that's going to go. We have no idea. And I think the point here is that we mustn't try and predict, and we mustn't suffer from recency bias and think that because this is what's happening, it's going to persist. People are saying that there's going to be disruption for years. This is a long-term game. And if it is, and like the Second World War was a long-term game, in 2008, it looked like a long-term game. In the middle of COVID, it looked like a long-term game. We didn't know what the outcome was going to be, but somehow things turn around. So what we have to do is arrange our regime, our routines, our whatever to keep a neutral mindset, to keep our mind open to what's possible. And we don't know exactly what's going to happen, but we do know that other variables are going to conspire to take advantage of this situation. And what we don't know is how long that's going to take and in what form it's going to take, but we know it's going to happen. And so keep an eye out, as much as there's so much gloom and doom in the mainstream media, keep an eye out for the green shoots as well, because they are going to happen. Now, having said all that, all those variables going on, the whole reason that we are mechanical investors, active investors, is that we don't want to subscribe to the noise, because the noise is what takes you out of the flow. If you get taken out of the flow and you get taken out of your process, you're not going to achieve your long-term goals. Sure, there's always going to be a little bit of pain along the way, because we can't eradicate it. We can't totally eliminate, when I say pain, our emotional pain when it comes to trading, I liken that to drawdowns. You cannot get rid of them. It's impossible. And we can't analyze our way totally away from it. We can improve and make little changes here and there as a result of what's going on, but we still have to define a way of how we make decisions and put our decision support systems into place. So these first three slides will start with just to say something's going to happen. We don't know what it is. And that's what Mark Douglas used to say. All we know is that something's going to happen. It can be anything. We don't know what it is, and nor do we need to know what it's going to be. And of course, fundamental truth number 5, I'll leave the two edge ones out in the middle, but fundamental truth number 5 is that every moment in the market is unique. So because what's happened in the last week or two, that doesn't mean it's going to persist and keep going for years and decades. We know that's not the case. If there's anything that we do know, we just have to stay alert, stay in the process, and stay in the flow. And one of the things that Mark Douglas, although it's not in his book, in his notes, in his Path to Consistency workshop, is he used to say that if you think you know, you're not in the flow. So if you think you know what's going to happen, you're not in the flow. It takes you out of the flow. And this is where we've got to stay true to our process. Right, now, liken to this, before I get into the market analysis, it's going to be a much shorter market analysis session today. I want to talk about market risk, because in these let's just go back. In these situations, I've taken off the market risk signals on these charts. So this is 2008, and so this is 2008. And you can see that, obviously the market fell, and there was a market risk exit signal about over here. I can't change it because we can have a look at it in a moment if you want to. There was an entry, then an exit, and then we're out most of that time. And so the market risk that we have in Beyond Charts and SPA3 Investor at the moment is effectively the same as the trader market risk that we use. And the two systems have a different term in which we want to trade. So sorry, this camera keeps on going off. So so what we've been doing for some time, and this has played a catalyst and bring it forward a bit, if you like, and doing a bit more research, is we've been researching a market risk filter for SPA3 Investor. And one of the main reasons for that is that we've also been, I've been trading a kind of research leveraged portfolio, is that with the leverage trading, leverage, and particularly getting up to 1.6 to 1, I don't believe that we can do that without a market risk filter. And you're going to see in a moment, and that effectively what happens is that no standard filter that I've come across, or even the filter that we use at the moment, which is really more a trader filter, can actually reduce drawdowns, which is what people are trying to do with the filters. They're trying to reduce drawdown and also at the same time improve performance. I haven't seen that anywhere, and that's not just my research. I've looked at tons of third-party research. I've researched other people's research, and I've also spoken to other people about their research. And like the two things are: you apply a market risk filter. This is provided that you have an edge that is good enough, obviously, to overcome the market, to be better than if you're trading with a market risk filter. Of course, there will be edges, and this might be one of the parameters that you use or variables that you use to decide whether the edge is good enough, is that if it has to have a market risk filter to improve performance, is that maybe the edge isn't good enough. But one of the things that a market risk filter does do, undoubtedly, is there are times when it takes you out of the market and it does reduce drawdown, but in every case, it also reduces performance, which is one of the reasons why we have, and because what you're doing is you're adding, you're taking away a degree of freedom. You're adding another variable, and you're adding another level of constraint, if you like. And that level of constraint is put into there, if to reduce drawdown, to remove emotion, to reduce emotional pain. So it's always trying to analyze away emotional pain. Whereas the more pain you can handle, the more comfortable you can be with being uncomfortable. The less degrees of freedom. The more degrees of freedom you have, i.e., less variables, less parameters, the more the system is freed up to go and do its thing. But along with that comes, and I'm not, this is not only me, plenty of Larry Williams has spoken about, there's plenty of people in these books over here have all spoken about this, is that you want to limit, you want to maximize the degrees of freedom, and you want to minimize the variables, and that is what a filter does. So I'm going to show you some charts today. I'm not going to show you all the charts that we've run over the last few days in preparation for this session, and also what we've been doing, if you like, in the background in our research. But I'm going to show you a few just to make a point. So the research, I can say, is nearly complete. It's been going on for some time, and I don't spend 100% of my time on it. I'd like to, but there's other things I've got to do. But we focused on bringing this out with the leverage trading that we're still working on, and we're not far off making some announcements in that. But it's also, let's have a look at it without using it in a leveraged trading environment, and look at it in an unleveraged environment. So what I'm going to do is take you through some market risk filters that we've done, and this is highly relevant. And why is it relevant? Because we've got a real live market situation now where this could have been relevant. So I want to put it into perspective, and some of you have written in to me as well, saying, how would a market risk filter go in this situation like this? So I'm going to show you. But when the market risk filters that we've done, there's obviously the current ones that we've got, which are really the ATR trailing stop on the S&P 500, the NASDAQ composite, and the XAO, the ones that we use, even though those current ATR TSLs are also used on other market equity indices and also ETFs. But we've also been, what I'll show you as well, just as a representation without going through tons, of a standard one that everybody kind of talks about, which is a 30-week / 150-day exponential moving average as a filter. So effectively, when you are below, when the price is below that 30-week EMA, you don't take any new entry signals until it's above, and so effectively it's an on-off. And you can use little variations here and there at and around the 30-week moving average, but that's a pretty standard one that a lot of people use. And the other one you can use is a 200-day, which is a 40-week. But no matter which ones you use, I'll show you roughly what the outcomes are. And there are other filters that people use as well that are pretty generic out there. And I'm also going to show you a newly researched longer-term market risk filter, which I've been working on for quite a few months. Spasmodically, and it's coming to a head pretty soon, where effectively you use these filters to either cease buying altogether when the price action is below, i.e. high, what we might call high market risk, and you only buy when the price action is above these filters, which is effectively what we call low market risk. But you have other variations, is that when it's below the filter, you can buy with a smaller position size, because the biggest negative effect that a market risk filter has is on performance, is that when the market does turn, that delay and it happening multiple times of getting back into the market when the prices start moving up, and having multiple delays like that for each market risk, coming out from high to low market risk, is what stunts performance. So if you have a position sizing risk management rule, if you like, that you actually, when it's below and you get an entry signal on your system, that you then do take a position, but with smaller risk, with a smaller position size, and you can come up with percentages of 30, 50, 3/4, whatever it is, and test those. So that can have some validity. Or you just cease buying until you get into a low market risk environment at the moment. And the other one that you can do is on the exit side, is when you fall below the filter, is that you exit all positions immediately, or you wait for an exit signal with your particular edge, and then you get out after that. And there's various combinations of all those. You can see it can get quite complex, and you see lots and lots of equity curves. But I'm just going to, without getting too complicated today, I'm just going to show you, 4 charts just to make the points. So 5 charts. So one is a representation, a proxy, if you like, of using a generic market risk filter, is a 30-week or 150-day. And what we're doing here is we're exiting on the signal. So when we go into high market risk, when you don't exit all your positions immediately, you actually just, because what happens is with an exponential moving averages, sometimes you get the price, dotting and going above and below over a short period of time. So you wait for an exit signal rather than selling everything immediately and then buying. So with a moving average or this kind of filter, you don't want to exit immediately. So exit on signal is probably the only applicable one here. But what happens is when the price action is below the 30-week moving average, is that you don't buy, you don't take any new entries. And so when you get a long downturn, works well. But of course, you also don't get in until the price, you don't start buying again until the price rises above the moving average. So that's what the handbrake is. So just to give you an idea, this is using SPA3 Investor on the USA, and this is going back to October 2015, which was the last low market risk before 1st of January 2016. Just pick that date, and you can see the gap here. And the longer this goes on, so that would be SPA3 Investor without the filter, the gray line, and the blue line is having the filter on, using those rules, and the gap just gets wider and wider. But you can see that the drawdown over the life of the portfolio, maximum drawdown will be lower for using the filter, and it'll be a little bit smoother. And you would probably have a few less trades in periods like this in the middle over here, because when you're below, you're not taking any new entries. So a little bit less activity, but you have less exposure, and of course you underperform. And you could try various market risk filters along those lines to try, and you would end up, now your filter should be aligned with the period in which you trade as well, most of the time. Having said that, even a short-term long-only system would suffer, with a short-term market risk as well. You actually want it to be a bit longer than what the period is. So it doesn't necessarily always be true that you want your market risk filter to be aligned to the period of your trading system. Okay, now let's have a look at what I mean by May 23 parameters. Remember, in May 23, we re-researched the SPA3 Investor parameters, and we just looking at questions. I'll get to them in a moment. Is that we re-researched and then we released those. So what's happened with the public portfolio is we had a set of parameters coming into the first, 7 years of the portfolio, 7 a bit years, and the last nearly 2 years, we've had a different set of parameters. So this is looking at equity curve with the latest and current parameters over the whole period of the research. So we're running a simulation here in the simulator and beyond charts. And we're using the current market risk filter using ATR TSL, and again, no buys when it's high market risk. So this is what the chart looks like. So the top one is no filters, no nothing, just trading as it is. The blue one, which comes second in this instance, is exiting on signal. And so when there's a high market risk happens, we don't just shut down all our positions, we wait for the exit and then get out. And the green one is if you exit immediately, and obviously you don't start taking any new entry signals until you get a low market risk entry, which is an entry on the NASDAQ composite. We use the NASDAQ composite here, not the S&P 500. We could show you all those, but we don't. We just don't want to confuse the matter. Right, so what you can just see here, the exit on signal, there was a high market risk signal around about here on the green one because we exited immediately. But you can see that the equity curve continued to move here, meaning that the currently open trades at the time stayed open until they gave an exit signal. Got to a point, this is 2022, where there were no new entries taken because we were below just high market risk. We were below the NASDAQ, if you like, had given an exit and hadn't given a re-entry. So with the green and the blue, they're quite a long way below. Now, I'm not showing you the numbers over here. This is all just very relative. It doesn't matter what the numbers are on the right-hand scale, but you can see that they're both, with the filter, they're both underperform. And similar over here, you can see that we exited immediately on the green, continue to get exit signals there. So drawdown in this period here in 2023 was much lower in these two equity curves, and also the one that had no market risk applied to it obviously had a bit of a deeper drawdown over there. Now, looking at the most recent price action, you can see both of these far less emotional pain. I think the green one, I'm not going to show you the numbers here, but you can. It is much less. It's like 5% or thereabouts instead of the 23% that's sitting over here in the public portfolio at the moment. So during periods like this, definitely play a role, but over the long term, the gap just gets wider if you use, that's the current market risk filter. So now I'm going to show you the new market risk filter, which we've been working on, and it's exactly the same rules, but it's basically a longer term market risk filter that allows the system to be traded even when there's small dips in the market, even maybe 10% dips in the market, but want to avoid 2008 type environment and also avoid the 2001 type of environment, which is going to happen. So all this is really in preparation for when the next secular bear market starts. If it hasn't already started, no prediction, is that we stay out of the really big moves. But and of course, there will be a bit of a delay in getting back in those really big moves. Now, 2008 is not shown here. I've just taken the last few years to kind of relate it to the public portfolio. So you can see the difference with this new market risk filter we're using, particularly for SPA3 investor. It's not 100% complete yet, but we're getting closer. Is that it drags up the performance. So again, I'm not going to explain the differences. You can see over here, gray line continued trading. Blue line continued trading for a while, flatter, but the green line got out immediately because we were exiting immediately. And here, the drawdown over here is now actually brought the blue, which is holding on to positions until you get an exit when a high market risk signal occurs, is much the same, but we still are outperforming the green line. And effectively, now you might say, well, gee, it's better to just exit immediately. But, at some stage, we're going to get these kind of conditions over here where they got down to being the green and the gray, which is the no market risk, got to be much the same. And then, of course, the market takes off. You start getting entry signals and you are invested in that period of time. So over the longer term, and you can see these periods over here, the same thing. And even here at the beginning, the same thing. So it really comes down to, how much pain can you take to stay in the game and stay in the flow and continue trading without market risk. Now, we've obviously narrowed these gaps because this is over a period of time. It's still enough compounded percentage points difference to warrant not trading with a market risk filter, but the drawdowns are going to be deeper. There's no doubt about it along the way. Now, that was the US. Same thing for the ASX. We found that using the current market filter on the ASX has a huge difference compared to not using it. So I'm not going to go into all the differences and point out what I did in the previous two, but there is a huge difference. And now with the new same equity curve, new market risk filter, i.e. longer term, you can see it does get closer and is better. And so the green and the blue, you trade a little bit less, you have less market exposure, your drawdowns are a bit less, but you do forego performance. Now, in the past, the market risk, excuse me, the market risk filters have always been available for all of our customers to use in SPA3 Investor. I know some do use it. They do reduce drawdown, but they do reduce profit. And but I personally, in the investment plans, the public portfolio investment plans, for these reasons, have not applied it. And I know a lot of people follow the investment plans that I use in the public portfolios, and I've had personal discussions with people that that have decided not to, for various reasons, depending where they are in the investing journey, etc., etc. But that is always available to you. But what we are going to do over the next, I'm not going to give a specific time frame, but we're getting closer with this research. I've spent a good many months on it already. Is to make this available, and then you'll have the opportunity to use it as part of SPA3 Investor as well as a market risk. Right, let's just summarize this market risk summary. Point that I have from my experience and talking to people is that more investors prefer less pain from lower drawdown than more pleasure from more profit. And that's Kahneman and Tversky. What they said is that people apply innately, if you like, twice as much negative feeling towards losing than pleasure they do from winning, and that keeps on coming out. To change your innate default hardwiring takes effort, and it's a sort of effort that you'd need to do to put into the Learn to Trade Properly training that we do. And we know that so far, we've been running these for 6 months now, 7 months, is we're getting fantastic feedback. And a lot of people are transitioning, if you like, or transforming to that kind of mindset where they're undoing, the innate hardwiring to put twice as much, displeasure on losing as pleasure as they do pleasure on winning. And they're starting to even that out, or even change it away, and even not the discomfort, if you like, and the displeasure that comes from losing is way less, has way less effect on them. And that is fine, but we do know that the minority are prepared to learn those necessary mindset skills and accept. Condition number one, Mark Douglas spoke about, is accept all the risks encountered in the financial markets, and then go on to be objective, to trust, to have confidence, and then to become consistent and to achieve consistency. But we know that we're not going to achieve 100% of our client base to be like that. And there are going to be some of you, and also some of you might just be in that stage of your investing journey, your life journey, where you don't need to get that much growth. So you're prepared to have a market risk filter. So that is why we're going to make that option. We're going to make a bit more emphasis on choosing which one you want to use when we get out of there. Point I made earlier, recency bias plays a much bigger role than the credit it's given. There's no doubt about that. And people in the environment that they're in, they default to thinking that it's going to persist and never end. Even though when you talk to them logically about it, they say, no, I don't think like that. But the way they act and feel is basically in response to the recency bias. And then you can choose whether you use a market risk filter or not. Okay, I'm going to quickly go into Beyond Charts now, and we are going to just quickly look at a few charts. I'm not going to go into the detail I normally do. The points I really want to be made around here are the indices. So I'm just going to look at just a few charts, and we start with the Dow Jones. So the point last week when I finished the session on Wednesday is that I said keep an eye out on whether the 38.2, so I think we were around about there, 2nd of April. Keep an eye on whether there's a 38.2 there, whether the 38.2% holds or not. Well, it hasn't. And that's really what instigated me doing the session and trying to give you some big picture perspective as well, and talk a bit about market risk. So it's now fallen all the way to 61.8, touched on that. And even though we had a big open, good positive open in today's trading session in the US, it obviously ended up in the red. So here we have risk on. We've been talking about these risk on indications coming for a while. We didn't know it was going to be this sharp and this steep, but effectively Dow Jones outperforming the S&P 500 is a risk off situation. It's telling you that things are a bit more risky at the moment. The price actions dropped out of the lower channel line here. So, and we right on support. Where is the support? Whoops, sorry, gone all the way out. Why have I got all data on there? We should go 25 years. Is that the all-time high was back here that previously, and we've fallen all the way to that all-time high. So effectively, where the Dow Jones was in January of 2022, we are just about all the way back there. So we're talking about 3 years now of sideways movement, even though that breakout occurred. So the secular bull to bear, I'm going to cover. I'm not going to cover it. I said the 30th of April. I'm probably going to do it a day later because I'm going to need the monthly data to come in and go through all the charts. So I'm probably going to do it on the Thursday, the 1st of May, and we'll have a look at it then. But that is the first question that comes to mind. Has a secular bear market started? I'm not even going to try and answer that right now. The next, looking at the S&P 500, also there is the previous high, the black. So again, 3 years of almost sideways movement is how we can look at this now. And we've crossed above 3.5% volatility on the S&P 500, which we last did back here in COVID. Where are we going? There's the COVID crash over there. And you might remember that there is a high volatility market risk rule, which we did bring in for people that want to turn off. So you can effectively turn off now. You can have a look up that rule in your manuals. What we did find, though, is that with the V bottom we had in back here in COVID, is that your performance would have been worse off by applying that rule. So it's entirely up to you. It is a high volatility market risk rule, and you can decide whether you do that now or not. So that is up to you, or you could trade through it and take entries as they come and still apply the rules. I haven't changed the public portfolios to use market risk yet, but that is an option for you to use the high volatility market risk rule. Okay, some questions here I'll come back to them at the end. Sorry, and I'm just about there. Won't look at these. They haven't changed since last week. We will look at this one. So effectively, this is the number of stocks in the S&P 500 that are below their 150-day moving average. And we are getting to pretty much oversold here. So these have all, that's 2019, 2020, that's COVID. Again, in 2022, we saw bottoms in the markets here. That bottom only was short-lived. These were actually quite long-lived after those bottoms, as was this one over here. We can go back a bit further and just look at the one that, this is 2008. 2008, it hung around down here for quite a while. So it got way down here in, when is that? That was October 2008. And then it took another 5 months, 4.5 months, and it stayed all the way down here for some time until we had the bottom in March 2009. That's a secular bear market. We're obviously still in a secular bull market for the time being, and we are getting to oversold conditions at the moment. Really, what are the conditions waiting for? They're waiting to see how the reaction to the tariffs actually play out. So it doesn't mean, so I showed you the 2008 one to show you that this can stay down here for a while. Very seldom does it stay down there for too long, but we are getting to oversold, and it could go a bit lower. So that green line's at 15%. So that breadth of market indicator it can be a contrarian indicator to where you see troughs. Now this is the US dollar chart. US dollar basket, the basket of stocks against the US dollar. And typically what you'll see is these going in opposite directions. They spend most of their time going in opposite directions. However, one of the things that Trump's trying to do is to weaken the US dollar, like China's been doing for 25 years. And because that obviously benefits the economics of imports when it comes to imports and exports. And also a weaker US dollar will also offset some of the tariffs and reduce the cost of imports, which everybody's saying is going to go up, and importers into the US, and that's going to flow through to the people. So he would like to see a weaker US dollar to make US more competitive on the world stage, offset and also offset tariffs. So what that means, if this analysis of all of this time over here of US dollar, so US dollar v equities ratio, if you like, which is this middle line here, and then I've put a Ciroc on it, is that a weaker dollar is probably going to mean a weaker equities market. Now, the correlation isn't 100% all the time, but this to me is going to be the biggest challenge to equity markets. Is if Trump is successful in doing what he's trying to do. There are a few commentators that are kind of seeing what he's up to. One is Robert Gottliebsen's written a couple of good articles this week in the Australian, and he's giving a totally different view to what the herd mainstream media are writing and talking about. So I'd urge you to have a read of Robert Gottliebsen's articles in the Australian, just to get another view. Not saying act on it or anything like that, but just to to counter, if you like, the other noise, the negative noise. And Robert Gottliebsen's not necessarily being positive. He's just saying this is potentially what the plan is, which will eventually become positive, but not in the short term. So in the short term, if Trump has some success in weakening the US dollar, this is not going to bode well for equities. And we'll have a look at the other chart in a moment, which is gold, because gold is, we'll talk about it when we have a look at it. So keep an eye on. So we've looked at the Fibonacci retracements. We've gone through 38.2. We're at 61.8. Pretty big retracement for a secular bull market. Atypical, but we're not in a typical time here, and we just have to see where that floor is found. In the meanwhile, decide whether you're going to use market risk signals or not, and keep an eye on the US dollar. Right, I'm not going to go through these. This is basically value versus all of these indicators, as we showed last week. None of them have changed. They're all favoring a risk-off environment. There's a sell signal on the discretionary. Discretionary is underperforming. Discretionary is underperforming staple, which is risk, which is also risk-off. We're now seeing the put call ratio starting to rise here. So the relative strength there's weakness. The 250-day moving average of the put call ratio starting to rise a bit, starting to see the equity. So the Ciroc rise there, which is pretty close to one of these, the red one, which will also be risk off. We've got interest rates, short-term interest rates rising, and which is also risk off. And we've got bonds starting to move in the same direction as stocks, which is what they typically do, and that's normal. So again, all this is risk off. The fear index, if you like, which is volatility index, is up in the extreme zone. How often does it get there? Not that often. This is a 25-year chart. That's 2008. That's COVID, and now we find ourselves back up in this extreme zone. So that is what's that basically saying, is that people are buying puts. That's really what it's saying, are buying puts as a hedge against the equity falls. So that is also a risk-off situation. We've seen the NASDAQ composite now fall below 61.8 and is, I thought I put a 78.6 on here. I did. There it is down there. We are now back to where we were 3 years ago, and back in the range. So there was the risk off over there on the so that was when the NASDAQ started underperforming the S&P 500. There's the relative strength line, which is also risk off, and we have the same in the NASDAQ 100 down to 61.8%. And all of this is now really painting a picture of stepping aside and being on the sidelines and being a market risk. What we're seeing here on the NASDAQ 100, when it comes to market breadth, we're getting to oversold situation. So the talk, like it was with COVID, was, is this are we going to see a dead cat bounce and then keep falling, or are we going to see a V bottom? And nobody can answer that. The only thing that's going to answer that is going to be the price action. The price action is going to react to all the variables and how they interact with each other over the coming weeks and maybe months. The SOX, which is the Semiconductor index, also down at 61.8. it's underperforming the NASDAQ 100, which in turn is underperforming the S&P 500. There was the risk-off signal all the way back there from a relative perspective. And here is the XAO, and this will be the last chart that I'll look at. We'll have a look at gold and Bitcoin quickly, and then we'll go to questions. So the All Ords has actually had a bigger relative fall to its run-up than the American indices. How do I know that? We've got a 78.6% retracement of the same run-up that we had over there, even though price-wise it is outperforming on the relative strength. Just from the Fibonacci, it's my view, it's underperforming. So that's two different ways of looking at the relative performance to the US markets. Right, just quickly go to gold and have a look at what's happening there. Gold is showing weakness at the moment, even though it's fallen a bit. It is outperforming equities, and we haven't seen a big rise in that yet. So we'll have a look at one more. What's Bitcoin doing? It's not really going anywhere. It's a risk off at the moment. So we'll keep an eye on both of those as well. Right. We'll go to some questions now, and we'll just bring up the S&P 500. Right. So let's go to the first question. Right, I'm going to wear my glasses out because this is very small print. Can you comment about the min trade from SPA Investor recently? Add any additional insight on this one? Okay, yeah, good. I'll bring it up. We'll have a look at it. It will be in here. In fact, I'll just go to the. Oh, there it was. There's the min trade. So effectively, the why am I not getting? Why is that happening? Okay, we'll go here. Okay. Why didn't anybody ask about the Regis trade? There's the Regis trade, which is an open Regis Resources. Anybody ask about Regis? No, nobody asked about Regis. We'll take that one, but we'll have a look at min. Okay, there's min. Effectively, there was an entry signal, a mechanical entry signal. You go, oh, yeah, but for the sake of this breakout being a little bit higher, we wouldn't have got into it. Obviously being affected quite dramatically by the tariffs, and being affected more than the tariffs. So the min trade, what I would do here is I would take a bigger picture perspective and have a look at its edge. So this is its edge going back to probably all the data. So 37 total trades, that includes this trade. The win rate of 51.35, payoff ratio of 4.8, expectancy 1.98, annualized return if you had traded min throughout the entire time, and as a one stock portfolio. This goes back to 2006 when it was obviously listed, and you would have an edge. You would have got a 26.95% annualized return as a one stock only portfolio, only buying and holding it. And you compared to the index over that time, buy and hold would have been 15.31, and compared to the index of where's the index? Sorry, I thought we had the index here. No. So it's got an edge, right? And if you don't need to know what's going to happen next, an edge is nothing more than an indication of a higher probability of one thing happening over another, and that's what you're doing. It's not a guarantee. So the market conditions at the time, we took it in our portfolio. We obviously didn't take the whole thing. If you were trading it as a one stock only portfolio, you would have lost a third of your capital, but over the time you still would have been way ahead. So it's anything can happen. It's an edge, and and that's what it is. There's a random distribution between wins and losses for every given set of variables that define an edge, and that's what that randomness is. And it's part of Anthony's. I mean, this is really what I've done there is just probably done the Learn to Trade Properly course in a nutshell. It's not nice to happen. How do we react to it? The degree to which we react to this with distrust, with discomfort, with disappointment. I'm not saying have zero of that, but the degree to which you react to it, and the degree to which seeing that, feeling it, and also what happens to your portfolio is the degree to which you will it will take you out of the flow. And you take you out of the flow, then in the long term, if it is a one stock portfolio, it'll take you out of this kind of flow, which is the edge that we have in MIN. I mean, I can't give any other answer, because there's no technical analysis that can predict the future with certainty. It also can't predict the degree of certainty either, in terms of how big is the win going to be, how big is the loss going to be. All we do know is that the average profit is 50.6%, the average loss is 10%. So we had a loss in this situation that was 3 times bigger than the average loss experienced in MIN. Is that abnormal? Yeah, it is abnormal. Are we going to experience abnormal trades in the future? Absolutely we are. Can we eliminate them? No. Can we get a rising equity curve over a large sample, with the risk that we can take to grow our wealth? Sure we can, but we have no control. There's a random distribution between wins and losses for any given set of variables that define an edge. Hopefully that answers it. Bruce is asking, is the high volatility market risk filter circa dead and buried? No, it's not. It's I just don't have it in my trading plan, in my investment plan for the public portfolios, so I won't be using it, but that doesn't mean that you can't. Okay, does the study takes into account where the lower drawdown allows more dollars to go back into the market versus the higher drawdown where lesser money is available? I think I am understanding that to basically say that your position sizing will be larger during high market risk, during low market risk than high market risk. And that's one of the options that we are researching. At the moment, it doesn't. So what I ran in those equity curve simulations is that it was the same position size. I chose not to show say for instance, taking a 50% position size during high market risk. I didn't want to confuse the presentation, but when we make this, when we've done that research, it's amazing that there's more positive in I can't remember which one it was, in the one market over the other market, but we will that's going to be part of the research that we put out when we release the market risk. Good. Gert is saying, Gary, why was there such a large drawdown for ASX Min? Okay, I don't know why. Basically, I do know why. The why is because the volatility level, let's just go here, volatility. So the volatility was obviously relatively, let's just put a value line on here. So when we got the entry, it was at 6.36. Where does that stand? It stands relative to the volatility, which is this is the percentage volatility. So at entry, it was 6.36. Because it was highly volatile at the time, we gave it, there was the multiplier that we applied just gave it a bit more room. And you might go back and look at during COVID and you'll see how much room some of these indicators had. Look at Intech at the moment, which is an open trade in the public portfolio in the US. It's down about 30% and it's still not near its TSL. So that is why the volatility and the multiplier, even though it probably would have been small, the actual average true range is quite big. And therefore, even a small multiplier on a big number, gives you a big trailing stop. And that's why it was so. And of course, every trailing stop, you go back and look, and it's a good exercise. Not only Min, but you go and look at all the trades at where the trailing stop is when the exit signal happens. And you can even use that in your portfolio. One of the columns you can add to your portfolio is you can actually put percent to TSL. And you can do that, but that's the answer to that. Is varying the TSL algorithm in times of extreme ATRV an option that has been investigated? Don's asking that question. It did get investigated, and when did we do it? We did it back here in COVID, and I'm obviously looking at one stock here, but so that's COVID 2020, and what we found, and this is maybe because you don't have big enough sample of market conditions in which to test that happening, but in COVID we had a V bottom. So in a V bottom type market where stocks rise pretty quickly, is even though the TSL is a long way away, because you can see here that the ATRV at the time here in Min, and this, so when was that? April 2020. 6.78. That's what much the same as ATR V21 at the moment. And because you had a V bottom and the price started rising, is that the trading stop trailed up pretty quickly. And what we've had here is we haven't had the V bottom, well, yet anyway, which meant that price kept on falling all the way down. So 2020 wasn't a good research environment, because even though the stops were miles away, the most of the stocks rose from the V bottom, which happened basically a month later. So the research that probably, which is why we came to the research we did afterwards, we came to the conclusion that in COVID, the COVID crash, it wasn't an advantage to use the high volatility market risk. Whether it will be this time or not, I can't say. I really can't. There's today's data. Gert is so it's down another 12% today. So I know I'm going to say every small loss is a victory against a large loss, but we don't know how far that's going to go. That wasn't a small loss; it was a big loss, relatively, 3 times bigger than the average for Min. But that's what we do. We've got to get out and follow the signals, and also not just look at what we've lost. We've also got to look at what we have a victory against losing if we didn't take it. And there's plenty of examples of people that don't take the exits, and rather than being a 30% loss, it turns into a 90% loss. So you got to take the exits. Okay, pleasure, Simon. Robert is saying NTC is down 30% from its entry, but still an open trade. Wow, I think I've just given that answer more or less in here. If we go to US, there we are. There's Intel. So what we don't know here is that is whether Intel is going to keep going down or not and actually lock in a loss, or whether it's going to turn around and go up. We just don't know. So if it turns around and goes up and doesn't lock in a loss, you're going to say, gee, great system on a sample of 1, or because obviously mineral resources is locked in the loss. Whereas if this turns around and goes up, like it did, let's go back to March 2020 and see what happened there. So look how far, wow, look how far away. Is ATR 20. Oops, I did 2. Let's just get rid of 1. So back here, there was volatility was 6.76, and we got out with a small loss trade, I would say, or maybe there's entry there, probably just a tiny loss trade over that period of time. But what's happened now is that it's fallen straight down and hasn't risen. So it's sitting at 8.99 now. What was volatility at entry? Volatility at entry was 6.13, a little bit less than what it was back at COVID. So there's a random distribution between wins and losses for any given set of variables that define an edge. And so if Intel turns around and goes up, you're going to go, wow, what a good system. We had a wide stop. It gave it room to move. It is high volatility. It's doing its job. But if it drops below and gives you an exit, you're going to say, oh, what a crap system, because it didn't know that what it was going to do. And what is the let's get rid of that and go to signals. And so what's the edge on Intel? 47% win rate, 104 trades, average hold period 102 days, payoff ratio 3.73, expectancy 1.23. So it has an edge. And if you traded this as a 1 stock only portfolio for however long it is, we got in the data, we got at least probably 25 years. The annualized return will come up in a moment. So what it's doing here when it takes this time is it's compiling a 1 stock only portfolio as if you traded all of the signals in Intel. You can see the buy and hold would have been up 12.4% annualized return, which is pretty good. It's matching the market. But you would have got a 14% annualized if you traded everything, and you would have had a 72% drawdown compared to an 83% drawdown. So you still have an edge, and we don't know whether it's going to be add to the losing column down here and that go to 56, or whether it's going to go to the winning column and that go up to 50 and slightly change the win rate and the payoff ratio. We don't know that at this stage, and nor do we need to know what's going to happen next in order to make money. So, and this is what trading is about. There's a great book written by Tom Hochart called Best Loser Wins. What does he mean by that? Those that can handle losing the best are the ones that win. And the better you can handle losing, the better you're gonna win over the long term. And Larry Williams used to say, this whole game is about how well you can handle drawdown. That's what this game is. And right now we're in the middle of a discomfort zone, and a pretty intense one. And the metal of all of us is going to be, the question being asked of our metal is how consistent are we through this period? How consistent and peaceful are we getting through this period? That was all of Mark Douglas's. That's effectively what he was trying to help us do. And we don't get tested when we have which is why nobody's asked about it. Whoops. Oh, why am I not getting it? Because I'm in Intel. I'm in the wrong watch list. Nobody's asking questions about Regis at the moment. Why not? Because you're not feeling uncomfortable about it. So you are just taking that for granted. Your pleasure as a measure of one, the displeasure you're getting from mineral resources is at least 2, maybe more, because it was 3 times bigger than its average loss. So I mean, these are good questions, and I welcome them. But this is how we got to think, and that is why those 5 fundamental truths. For those of you that I know, we've got so much good feedback from the Learn to Trade Properly study groups that are going on. And Tito posted on his forum the other day that he's feeling, even though he's in the middle of this, it's taken him 17 years of being an active investor to be able to feel like this in the midst of a pretty adverse set of circumstances that are happening in financial markets. So it's that's what trading is. Right. What else have we got here? Mark is saying, sorry, Bruce, recently 83% drawdown on buy and hold of min. That's correct. Yeah. So sorry. So what that means by, that min, maybe I didn't explain that, is what that 83%. So here, let's have a look at this. So or Intel. So Intel is a minus 72% maximum drawdown of buy and hold. So is that buy and hold? It's buy and hold, min. So what that means is min. So Steve says 83% drawdown on buy and hold of min. That means that its biggest fall was 83% over the life of, if you had just the price action. So that's if you had bought and hold min as a stock the whole way through. Sorry, I've jumped a couple here. Robert, we've done. Anthony's just saying that min is down 12% today. Steve Nelson, so 83, that's done that one. So Bruce is saying recent leap in EVN. So let's go to EVN. Yeah, so the gold stocks have been doing okay. So there's EVN gave an exit signal and got out. We don't know where it's going to go from here. It's just made a new all-time high. How do I know that? Because I've got my black. Why is it doing that? Whoops. I'll come to having a bit of a rest. Okay, let's do questions. Can you try using the VIX sub 30, for example, to re-enter? I don't think that's a good idea to. So what Mark is asking is you wait for the VIX to fall. VIX to fall below 30. Which is round about there, and use that as a re-entry. VIX is pretty volatile, and so to have firstly the number of times it gets above 30 it would be quite. I've got a high over here. What is that? That's at 33.2. They're around about 33, maybe, but I haven't tested that, Mark, at all. Ken is saying, I think the earlier question meant if you have, say, $100 in a share and it loses 50%, then you would only have 500. So then 50%, if you have $1,000 a share and it loses 50%, then you would only have $500. Yeah, but that's in that particular stock. That's why you trade as a portfolio. I mean, that's just really diversifying your strategy across using position sizing and money management. Okay, so sorry. Okay, so 50, then you would only have $5. So $100, then $50. Sorry. Okay, to reinvest when the market improves. What is the impact of this going forward? Well, that in that particular stock. If you so okay, I'll get where you're going. Let's go min. So what you're saying is min. And let's go here. So the measurement is the measurement, right? Let's go signals. So what that was earlier, that I think it was whoever it was asking the question, is that at some stage the maximum drawdown here is 53% if you had bought and held min throughout its life as a one stock portfolio. So yes, at some stage you lost half of your portfolio, your one stock portfolio, but you still got 26.95% annualized return. So it gives the date. Okay, so that's the date now. So it is even better before that. So because it's using compounding and it's actually taking 100% of the portfolio, is that now you're sitting at 53%, but it doesn't give the other drawdowns along the way. Well, here's a good example. Okay, it's 85%. I need to find an example where the drawdown was 50%, maximum 50%, somewhere in the past. But I don't know what it was over here. But sure, you're right. You'd be 53% drawdown, and that's if you're a one stock portfolio. And if the stock now goes nowhere, you still got over the period of time, you still got a 26.9% annualized return to date, and you're out. So you're just going to have to trust this edge over the trades that have happened, that the next time you get an entry signal, you can potentially get that. But nobody trades a one stock portfolio. But yeah, the point is valid. That could happen. But there will be other stocks, I'm not going to go and find it now, where that 53.8% happens somewhere back here, and then you've got the return after that. That's why you don't trade a one stock portfolio. Okay, so advise that one. I think there's one last question. Can a buy and hold index value be put into the statistics for comparison to the stock? Yeah, so I thought we had that. That's the buy and hold there for actually the stock, and I thought that's why I was actually looking for that earlier, and I didn't find it. Yeah, we can do that. We'd have to add a bit of this one for. We'll talk about it afterwards. But we'd have to choose which index and all that. We can do that. That's something we can put on the list. And then you can see how. But we do know that 26.95 over that period of time. Yeah, I mean, you can do that manually now. You could go and pick the date. So you could go back to 2006, and you could in fact overlay. In fact, I could do that right now. You just won't get the numbers here. Let me do that as a way to finish. I know we've been going on for a while, but I'll quickly do that as a lesson in using the tool. And we'll do that in a moment. Don, let's do that first, Don, and then I'll finish on the lesson. So Don is asking what, let's go DMP. So now we're sitting, rather than looking at a historical trade, let's look at at one that's just happened, which I put my market on close order on to before coming into the session. So DMP has a 55% win rate, has a expectancy of 1.7, payoff ratio 2.73. Volatility doesn't really get that high. It's got a little bit more volatile recently, but the point that Don's making is there's an entry signal that occurred overnight, and there is where Domino's is trading at the moment. So what are we going to get, a winner or loss trade? Well, we don't know. So what are we going to do? We've got to stay in the flow. And those of you that are doing LTTP, you're doing it with an amount of money that should test you enough to be hesitant, but not so much that it takes you out of the flow, takes you out of executing the edge, takes you out of being consistent and being confident and being trustful and being objective and accepting. Right now, the first step is you've got to accept all the risks that can happen with this trade. What are the risks? Well, the risks are that you lose. That's the first one. The risks are that you see yourself as being wrong for having decided to use pass-through investor, and that is a mistake. I shouldn't have done it, and therefore I beat myself up for being wrong. Then you're also fighting at the same time to counter that, the fear of missing out. So what if I don't take this and and it does take off, and it ends up being a trade, one of these trades that occurred over here. And the moment you start doing it and you hesitate, now you start analyzing. Why? What am I analyzing? Why am I hesitating? I'm hesitating and analyzing because I want to analyze away the potential of having some loss, of being wrong. I want to analyze the way and to be right. I want to analyze away the potential, if you like, for feeling uncomfortable, for feeling disappointed, which are all mindset issues, right? So how do you do that? You've got to become objective. How do you become objective and consistent? You have an edge. So you define your edge. Is that edge going to win all the time? No. How much is it going to win and lose by? Well, you don't know exactly going to the future, but you got to turn to some kind of baseline to say, what are the probabilities of how I win and lose? And that's why you go back to objectivity. So here we have a case in point, is that the more you have hesitated to take this position is the degree to which you are out of the flow. Those of you that just executed, just went and put the order on and didn't do any analysis, you may have thought about whether you should or shouldn't have, but you didn't. That was instantaneous, and you overcame that. The degree to which you, how long you take to ponder and hesitate over doing the trade or not, is the degree to which you yet do not have the mindset skills required to achieve what Mark Douglas spoke about all the time, and that is the mindset of consistency, the number one skill that you need to be successful in the long term. But I won't hold it against you if you thought, should I? No, I'm going to do it. Why? Because I accept the risks. That's fine. But if you spent the whole night thinking about it, pondering it, you still got into the morning and you're putting in the trade or whatever it is, then you have not achieved consistency yet. So hopefully you get an idea. The whole world is against you at the moment. You got everything out there, and you get this exit signal. And then you could go and say, wow, it only just got above there. And yesterday was a big day. There's a bit of a debt pounds. It's in a downtrend. You could talk yourself out of this in a nanosecond using subjective technical analysis. Then you can go and get a newsletter and say, well, what is somebody else saying about the fundamentals? What I'm going to do is I'm going to bring up the fundamentals here. I'm going to see what it says. It says over here that I've forgotten how to use this. I haven't opened it such a long time ago. So the yield, the earnings yield is 0.69. Wow, that's low. Earnings per share is low. PE ratio is massive. It's 144. The dividend yield's 4%. Okay, well, I'm not going to buy something with that amount of yield, and I'm not doing the trade. You're out of the flow. You do not subscribe to the 5 fundamental truths that anything can happen. I do not need to know what's going to happen next in order to make money. There's a random distribution between wins and losses for any given variables that define an edge. An edge is nothing more than an indication of a higher probability of one thing happening to another. And every moment in the market is unique. You're not subscribing to those principles, so you don't have any principles. You don't have any truths that define your true north for how you execute in the market. You're just going to be at the whim of whatever the news or the noise is at the time. And you're going to succumb to what's the variable at the moment? It's the Trump tariffs. So therefore, I'm going to, is that written into my trading plan, my investment plan? Probably not. But so what? I'm going to override it. I'm going to put a new rule in. That is not consistency. So thanks, Don, for raising that. It's all of my favorite topics all out there, out on the line, and hopefully you're learning from that. And this is a good time to learn. There's no doubt about it. Okay, James has just said, Ken, I recently did some calculations in my min-loss trade. This was a 1.1% loss of my total invested amount across my 3 portfolios. Much more peaceful to look at it in a larger picture. Thanks for that. Thank you for adding that, James. Right, what I was going to do was, the question was, how do you measure against the min against the index? Okay, so we don't have the stats written over there at this stage, but what you can do is, and I'll just clear chart, we'll turn off, we'll just clean it up a bit, turn that off, and now we've got a clear chart. And what you do is you go to indicators, you go to base reference, and you do a base reference against the dollar XJOA, that one. You apply it, 2014, let's go 2006. and let's apply. And now you put a value line against it, and on that value line, so although I haven't got an annualized return, what I've got here is min is up 1,154% over that time, and the index is up 234%, so roughly 5 times more, and you're ahead. So if we did put annualized return in here, or growth, or so you'd effectively annualize that 234%. How do I know what that is? There's a way of doing it if you, and you could do it in Portfolio Manager because it would work it out for you. But that's one way of doing a relative against but we could put those stats in here as well, but that's how you can do it at the moment. Right, there's been lots of questions, been going around a quarter. Hopefully I've helped you get some bigger picture perspective on what's happening in the market, that there's always going to be a big variable that comes along, a big slush ball variable from left field at some stage. They don't happen that frequently, that it affects everything. We have one now. Now's the time to look at history and get a big picture perspective on it, and to just keep on seeing that. Stay neutral, stay in the flow. And of course, the other thing, we're always doing analysis and re-research every now and then of various aspects. We're not reinventing the wheel. We're just improving, and there's nothing wrong with doing that. We've got to adapt and do that from time to time. But what we're not doing is throwing out the concept and starting from scratch. We're fine-tuning, we're adapting, we're innovating, and that's what we do here. You can do that yourself as well. If you come up with a great idea, send it in. But there's nothing stopping that. We want to, and then we put it into our investment plan, and then we execute it. What we don't do is execute research on the fly as we're doing the research. Hopefully that hits the mark, and I'll be back next week. We will look at the portfolios and see how they've handled this situation. And when it comes to announcements for adding functionality and research to products, well, we'll have that out for you and announce them as soon as we feel we're in a position and ready to do that. So as always, I wish you consistent, objective, and peaceful, active investing.